Bond bears kind of stole the show from stock bulls this week. That was the main takeaway ahead of another big one ahead of us with the election and the Fed next week. Risk radar shifted with the green light fading from equities, partly thanks to big tech softness around earnings, but also thanks to bond bears who just look ferocious right now. A couple attempts to buy treasuries this week on a strong 7-year auction, and then just a bizarre, weird data print affected by outside forces, but still, a low number of jobs added on payrolls. None of that could get in the way of yields moving higher. But if you've been following along, then this wasn't a surprise. Why would anybody be buying bonds right now when yields have been going up after 50 basis point cut, and apparently the market says they're absolutely going to do it again next week? The argument is that the Fed might be overstimulating, but inflation hasn't turned around back in a fearful, scary enough way to prevent them from continuing to cut and provide some easing to an economy that we have seen evidence of slowing within. Of course, jolts this week again told us, as Guy Berger reminded us, air is coming out of the COVID economy. Now, nominally, we're still in pretty good shape. Manufacturing wasn't great for ISM, and the prices paid were a little bit too high still. That's where the selling in bonds does get a little bit worrisome, because the 60-40 portfolio strained this week, and that was a fairly new phenomenon. Now, it doesn't mean we have to go crazy and start worrying about 2022 yet. The fact that earnings hit with some very high expectations and high valuations complicated the relationship between stocks and bonds, but it is important that when stocks were down this week, bonds were too, and treasuries didn't do much to hedge big tech selling. The crypto light probably should be yellow, because I feel that there is an immense amount of volatility potentially next week for crypto around the election. But another important takeaway this week is that when there was more evidence, these moves haven't really been about the election. I think Bitcoin may be the only one, and crypto possibly, because that's kind of the only concrete real policy bias we've seen between one side or the other. But the prediction markets narrowed again this week in a big way, making the prediction markets look a lot more like the polls, essentially at a coin flip. But bonds kept selling off throughout it. So that tells us that the bond story hasn't been about the politics. It's been about the economic data, the fact that the Fed is going to continue to cut most likely. Watch Bitcoin next week for maybe some indications on Monday of how nervous the market is around the election. But generally, I think that if you're bullish, you should be hoping for a non-contested election, a big enough one-sided victory, regardless the direction, to keep volatility out of the market, bring VIX down, and help kind of normalize some of these relationships. Then maybe we'll revisit, once we know who the victor is, on what is dependent on politics. I do think crypto one that we want to watch for volatility. Other than that, though, we know the general trend. Yields have been ripping this week. Stocks are in a little bit more of a delicate balance at this point. I'll see you next week. Have a great weekend.